It took only a matter of hours for the 16th largest bank in the United States to go from stable ground to underwater.
More financial uncertainty for people to contend with this week. Why is this happening now? And whether or not your money is safe in the bank.
Today we are going to talk about the US bank collapse. I have waited a couple of weeks for this because I was waiting for more banks to fail, which it did. There were a total of 4 banks that failed in the US. It was Silicon Valley Bank, First Republic Bank, Signature Bank and Credit Suisse. And all of this happened in 1 month. We are first going to talk about how the banking system works because it's very important to understand how they work in order to understand why SVB failed. And then we are going to talk about how Canadian banks are different and we are a little bit more risk averse and safer than our US counterparts. Then we talk about how to protect ourselves if a bank fails in Canada and what I do to protect myself. And finally, we are going to talk about, is this an early indicator of what happened in 2008, the collapse that happened? And we are going to have a couple of points on that, which would really help you. But before I start the video, it'll be amazing if you subscribe to the channel and do like the video if you like it, because there'll be a ton of information in this particular video. First, let's talk about how does the banking system work. So what happens is, let's say this is me or a random person who has cash deposits of $1 million in one particular bank. And then the bank pays them 1% interest rate, which is really on the higher side, I would say, but right now 1% is fair. Let's say it's 1%, which is $10,000 a year in interest. Now the bank pays this person 1%, but they actually lend this money out at a much higher interest rate so that they make a much bigger return, and that's how they make a profit. So let's assume this particular bank put $250,000 in government bonds, because government bonds are usually supposed to be the safest form of investment. And let's say they get a 3% on the bonds that they invested in, which is $7,500 a year. Then they give home loan out to one particular person or maybe the same person for $500,000 at 5% interest rate, which is $25,000 a year. And then they gave out a line of credit of, let's say, $250,000 at 10% at $25,000 a year. So in all, they actually earned more than $50,000 when they only gave $10,000 to this particular person. Now, this is a very simplistic example. I know it's a lot more complicated and they are supposed to keep part of the deposit in the bank as well. But this is how banks actually make a profit, and it's important to understand what happened with SVB now. With this context, let's now talk about what happened with Silicon Valley Bank. Now, Silicon Valley Bank worked with 50% tech startups and venture capitalists in California. So they have assets worth of $200 billion and they are exclusively or almost exclusively to tech startups, which is kind of risky. Now, I saw a reel yesterday where the person said that SVB did not have enough money and that's why they failed. And that in fact is not true. In fact, Silicon Valley Bank had too much money and they were actually not gambling away all the money into risky investments. What they were doing with the excess money was in fact putting it into government bonds, which are supposed to be very safe. But their mistake was lack of diversification and buying too many bonds when the interest rates were rock bottom and it paid less than 2% yield. Now, when the interest rate started going up, their bond investments plummeted in value. Now, just imagine if you buy a bond which pays 2%, no one is going to buy that same bond at 2% when a new bond is available at 4%. And when the interest rates go up, the yields go up and therefore their bond investments plummeted in value. Now, because a lot of their deposits are coming from the tech companies and tech companies are really struggling right now with liquidity, with funding. Now, they are not getting venture debt, they are not getting venture capital, they are not able to raise investments. And when this happens, what startups have to do is exhaust their savings and eat away their savings because they still have to make bankroll, they still have to make product, and they still have to be in the market and sustain in the market. And what tipped the collapse was the rumor that Silicon Valley Bank has liquidity issues, and that is what led to a bank run where $42 billion were withdrawn in one day, which is 25% of all deposits in Silicon Valley Bank, because these startups who had kept their money, they were just worried that Silicon Valley Bank will fail. Now, in order to meet this demand of deposits, they had to sell 21 billion bonds at a lower price and accumulated almost $2 billion in losses. And they also started selling shares, and that did not help their share price as well.
Dark and shuttered, Silicon Valley Bank is no longer open for business.
The bank shut down and so many startups lost all their money and could not make payroll. Now, you might ask that, isn't all these deposits insured? And in fact, they are. In the US, it's called FDIC protection, and the deposits up to $250,000 are actually insured. Now, $250,000 is enough for people like you and me, normal people, but for companies, this is nothing. And 95% of the companies who had put their money into Silicon Valley Bank had more than $250,000, which was a massive problem for these startups. Now, thankfully, the government actually bailed out the bank and paid all the startups their deposits, but the question arises, what if they didn't? Now, there is another important question that we need to answer. How are Canadian banks different, or are they susceptible to this kind of a collapse as well? Now, there are a few facts that we need to look at. The first one is Canada has 34 domestic banks, whereas US has 7,000. So just imagine the kind of regulations that you have in Canada to be a bank. Now, the top 5 banks in Canada control 80% of market share, which is less than 40% in the US. Now, because it's such a consolidated market in Canada, it allows for a lot stricter regulations and it allows for a lot more diversification because they don't put money in only startups or only bonds. They have to diversify because the compliance is so strict in Canada. Now, when I say it allows for more diversification, because the Canadian economy is reliant on these top 5 banks, these top 5 banks cannot do what Silicon Valley Bank did. They cannot rely on only startup deposits. They cannot rely on only putting the money in bonds. They just cannot afford to fail, and therefore they have to diversify their investments so that if one thing fails, the bank doesn't collapse and they're still able to sustain from the profits in other investments. And one other interesting fact is that no bank has collapsed since 1996 in Canada, whereas 563 banks have collapsed in the US since 2000. But we'll talk about that in a bit. But first, let's talk about insurance. In Canada, there's something called a CDIC insurance, which is Canada Deposit Insurance Corp. Now, to explain this, there's a very interesting chart that I saw on the CDIC website where it says that your deposits worth $100,000 are actually secure. And it's not just per bank, it's per security. What that means is that if you have $100,000 in your savings account and in the same bank you have $100,000 in your RRSP, both those deposits will be secure as long as they do not exceed $100,000. And if it exceeds $100,000, let's say $200,000, you will get the $100,000 back if the bank fails, but the other $100,000 is what you will lose. In fact, if the bank fails, CDIC's SLA is 3 working days. So in 3 days, you'll actually get access to your funds. But note that it does not cover mutual funds, stocks, and crypto unless they are held in one of the registered accounts which are listed on the left of the screen. Now, I do understand that Canadian banks are a lot safer than the US banks, but we still need to protect ourselves and make sure that if a bank fails, we don't lose all our money. And the number one thing to protect yourself is have a primary account in the top 5 banks. Because honestly, if the bank fails, and even if you had more than $100,000 in your bank account, there's a very high chance that the government will bail the big banks out. And therefore, it's very important to understand that you should not be lured by a high interest rate by a much smaller bank. Just keep your main account, which has most of the money, let's say you're saving for a house, in a top 5 bank, and that way you'll feel a lot more secure in a time like this. In my case, I have 3 accounts. I have my business account in BMO, then I have my personal account in Scotiabank, and I have my emergency fund kept in EQ Bank. And they are all CDIC protected and the amounts are less than $100,000. And therefore, I know that if one of these banks fail, I am still secured by CDIC. The second one is, and this is what CDIC protection means, no account has over $100,000. And if there's one account with more than $100,000, just make sure that you open multiple accounts. For example, for me, in my BMO business account, there was a time when I had more than $100,000 and commissions work like that. Sometimes you have more money. So I made sure that I segregate my businesses into 2 parts, and therefore I could actually open 2 bank accounts in BMO or 3 bank accounts in BMO. And that way I can secure my funds because I'm keeping it below $100,000. And the third thing that I've started to do after the collapse of this bank is that I keep some money at home, which is $1,000, because if I have 3 days or 4 days before I get the money back from CDIC, because the money is insured up to $100,000, I still need to make grocery, I still need to have some expenses, so I keep $1,000 at home. However, unlike this guy, do not keep it under the mattress, because if there is a robbery, that's the most obvious place to keep cash and you will lose that, and that's not CIDC protected. And the fourth point, and probably the most important one, is do not put all your eggs in one basket, and it's very important to diversify. If there's anything that banks or us should learn from what happened with Silicon Valley Bank, is that we should diversify our personal portfolios as well. For example, for me, I have TFSs in stocks, which is $25,000. I have crypto, which is $40,000. I have physical gold and silver, which is $25,000. And then I have emergency fund of $50,000. And it's actually split into multiple accounts. So I've diversified even my emergency fund so that I always have access to some money, even if something fails. Now, a lot of people say where I keep my emergency cash. I actually keep it in EQ Bank, which gives 2.5%. In fact, at the time of recording this video, they are giving 2.5% return. I'm not trying to beat inflation. It's my emergency fund. I need access to this money whenever I need it, and therefore I keep it in EQ Bank. I'll post a link in the description for EQ Bank. It's a pretty big bank. Yes, it's not a top 5 bank, but it's still a very safe bank to work with. I do mortgages with this bank as well. In fact, my home is mortgaged with EQ Bank, so I have a lot of trust in this. But again, the banks can fail, and therefore it's very important to diversify. So you can use the referral link because it can buy you a few coffees for free. Now, my investing portfolio is very much skewed towards real estate because that's what I understand. That's my profession. I just get a lot of good deals because I'm in this profession, and it's worth $650,000 now in equity. Obviously, it's not all liquid, but even that is diversified into different investments. I have my primary home where I live, so that's not an investment, but I have a lot of equity in this house. I have a condo in Kitchener, so this is a house, that's a condo, so that's one form of diversification. And I bought a duplex in Calgary, so that's a provincial diversification that I've made. And then I bought an 8plex in Ohio. I have not made a lot of videos on that right now. I will be making an entire series on US investing, but I bought an 8plex in Ohio, which is diversifying in terms of countries as well, and in terms of, how many units you buy. So even within my real estate investments, I've made sure that I diversify. Now, a lot of people have asked me how you diversify with stocks. I actually don't. I just keep it simple and invest in the economy, which means that I have $2,000 a month. I actually do it $500 a week every Wednesday. I've talked about this many times. And I split this into $1,000 that I put in top companies in Canada through ETF, which is XIC, VDY, XCI, and VRE. VRE is basically a REIT. And then $1,000 in S&P 500, which is in the US, through VFV. And that way, I'm actually investing into hundreds of companies, diversifying my portfolio automatically by just investing into these 5 ETFs. And historically, they have actually given a return of 7 to 10%, which is more than enough for my stock investing portfolio because I'm investing for the long term, but I'm making a lot of my investments and a lot of my returns from real estate. Now, the last point, and I'm pretty sure if you have watched the video till here, you are looking for an answer here. Is this an indicator of another 2008-like collapse? And the answer is maybe. But let's talk about a little bit of facts on how 2008 subprime crisis happened and how is it different from what's happening right now in Canada. Now, in 2008, what happened was there were ninja loans given, which is no income, no job approved loans, and they were given by thousands of lenders. What this basically means is even if you don't have a job or if you have very low income, you will still get approved with very little down payment, and you are obviously upside down on your loan if the market collapses. And that's what happened back in 2008, which did not happen in Canada back then, and it's definitely not happening right now because Canada always had a stress test where you actually qualify 2% higher than whatever the interest rate is that you are getting. And 67% of all the mortgages are with top 6 banks with a lot of compliance on documentation and the way you can buy properties. The second and probably the most important point is subprime mortgages in US are 20%. Subprime basically means that they are not qualifying at normal interest rates with banks. They're actually qualifying because they either don't have enough down payment or they don't have enough income, and they're qualifying with private mortgages or alternate lending. And the alternate lending norms in the US are not very strong, and you would get qualified even if you do not have a lot of income. And in 2008, when the crash happened, this was estimated to be over 50%. So subprime mortgages were as high as 50%. Whereas in Canada, it ranges from 7 to 12%. And subprime mortgages in Canada still requires you to have a lot of compliance. It still requires you to have a decent credit score. It still requires you to have decent down payment, 20%, because you're doing alternate lending. And this house, in fact, is with an alternate lender, which is Equitable Bank. And I know that I shared a lot of documentation to get qualified, and my interest rate is not crazy. It's just 0.5% higher than a bank. And the reason why I went to alt is because I'm self-employed, and self-employed norms in Canada are very strict. You need 2 years of income. All this to say that even though subprime mortgages are 7 to 12%, the definition of subprime in Canada is a lot different from what it is in US. And in fact, private mortgages only make 1% of Canada mortgages, which makes the default rate really low in Canada. But honestly, never say never. Anything can happen. If a big bank fails and the government is not able to bail them out, there will be a lot of jobs lost because all these big companies have their deposits in big banks. And if these big companies are not able to make payroll, obviously because the bank has failed, there will be a lot of people who will lose jobs. Unemployment will actually rise a lot. We will go into a deep recession, and that would lead to a 2008 style collapse. But the probability of that happening right now is very slim. But in all this, there's actually good news for first-time home buyers because the interest rates have actually dropped a lot. Now, the reason why interest rates have dropped is because when the banks collapsed, people actually lost trust in the market. There were a lot of people actually putting money into the government bonds, even if they gave lower yield. Which makes sense because there's no guarantee that all these stocks and all these banks would do well or not, which bank will collapse. They're just putting all their money out from banks and putting it into government bonds, which are supposed to be the safest investment. Which makes sense because governments have never defaulted on any loans. And because more people are looking for safety and not higher returns, they are willing to buy bonds at a really low yields. And when bond yields go down, fixed rates automatically go down, and that's what we are seeing. The fixed rates in the last, like less than a month have gone down by 0.4 to 0.5%. So if you are looking to qualify, do book a call with me and I may be able to qualify you for a lot more than you think. That's all I have for today. I hope you like this video. Do like the video because the YouTube algorithm will then know that this video is relevant to more people like you and more people can be helped. The next video that I make is for first time home buyers who are looking for what is in it for them if they're buying the house for first time. What are the advantages? What are the various programs that can actually help you buy your first house? It will be a very informative video. So मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।